Hey there, and welcome to our channel where we turn complicated money matters into simple, actionable steps. Before you dive into the world of investing, let me ask you something. Do you feel prepared? Or does it feel like everyone else is playing the game while you're just standing on the sidelines? Well, don't worry, you're not alone. Starting your investment journey can feel intimidating, but I've got your back. In today's episode, we're breaking down the 10 things you need to do before you start investing. These steps will help you build a rock-solid foundation so that you can invest confidently and avoid rookie mistakes that could cost you in the long run. Grab a notebook or your favorite note-taking app because trust me, this is the checklist every investor wishes they had before they started. Ready? Let's jump into step 1, because investing isn't just about money, it's about mindset too. Number 1, define your investment goals. Short-term goals, saving for a vacation, a car, or a down payment within 1 to 5 years. Long-term goals, retirement, funding children's education, or building generational wealth. Income goals, generating dividends or regular passive income. Number 2, assess your risk tolerance. Conservative low-risk investments like blue-chip stocks, bonds, and index funds. Moderate balanced exposure to equities and fixed income. Aggressive high-risk, high-reward investments like growth stocks, emerging markets, or speculative assets. Number 3, determine your investment time horizon. Short term, avoid high volatility stocks, focus on stability, like ETFs or bonds. Medium term, blend of growth and dividend stocks. Long term, focus on growth and reinvesting dividends. Number 4, portfolio allocation. Use a diversification strategy to minimize risks. Equities should make up 50 to 70% of your portfolio. This includes both domestic and international stocks. Large-cap or blue-chip stocks are reliable and stable companies. Mid-cap and small-cap stocks, on the other hand, offer higher growth potential. Don't forget sector diversification. Include tech, healthcare, energy, and other sectors. Bonds should account for 20 to 40% of your portfolio. They are safer options that help stabilize your portfolio during market downturns. Lastly, allocate 5 to 10% for cash and alternatives. This ensures liquidity and allows for investments in things like REITs or commodities. Number 5, choose an investment style. Value investing focuses on undervalued stocks with strong fundamentals. Growth investing, on the other hand, involves investing in companies expected to grow significantly. If you prefer a steady income, dividend investing targets dividend-paying stocks. Lastly, index investing uses ETFs or index funds to track market performance. Number 6, select investment vehicles. You can choose individual stocks based on thorough analysis and research. Mutual funds or ETFs allow you to diversify efficiently and cost-effectively. For those who prefer a hands-off approach, robo-advisors are ideal. They automate portfolio management, making them perfect for passive investors. Number 7, research and analysis. For long-term investments, it's important to use fundamental analysis, looking at things like earnings, the price-to-earnings ratio, and so on. On the other hand, for short-term trades, technical analysis is key. This involves studying charts, trends, and various patterns. And don't forget to track economic indicators such as inflation, interest rates, and GDP growth. These factors can really influence your investment decisions. Number 8, regularly review and rebalance. Review your portfolio every 6 to 12 months. Rebalance to maintain target allocations. And hey, consider the tax implications of trades. Number 9, risk management, stop-loss orders, set limits to minimize losses, position sizing, limit the amount of capital in any single stock, and don't forget, keep an emergency fund with 3 to 6 months of living expenses in cash or equivalents. Number 10, stick to your plan. Avoid emotional trading based on market volatility. Focus on your long-term goals rather than short-term fluctuations. And there you go, 10 things you will need to do before you start investing. If you did enjoy this video, make sure you like, share, and follow for more. Thanks.